new Treasurer, Jim Chalmers, or Dr. Jim Chalmers, has announced that there's a review up, Kooky. So, I mean, do you think there's going to be a change in the 2 to 3% range that the Reserve Bank I think they adopted in 96, around that period?
Yes.
Or do you think there's going to be some different emphasis from what the RBA will be looking at, the governor will be looking at in terms of where he's going to take rates? Is it around wage increases, indexes? Is it around employment numbers, etc.? What do you reckon?
Look, I think the review's not going to be dramatic in terms of what the targets are. I think the 2 to 3 will be a percent target for inflation will still be maintained. There might be a slight change in how the Reserve Bank is made accountable for things like the labour market, so full employment, with an eye on wages, with an eye on underemployment and these sorts of things. The financial stability, managing, what do we call it, systemic risk in the economy will be another part that probably gets elevated in a more formal sense. Now, clearly,
systemic risk, just explain that though.
Oh, if you overhike, you cause a recession, and you're not going to cause a recession just to keep your 2 to 3% target range. They might be a little bit more flexible with that target range.
Are you sure about that? Because I'm worried.
I'm not sure about it. No, I don't know. I've got no insight on it.
Because I'd like to hear from both you and Bill on this, because is inflation such a big problem, such a scary thing, that they'll say, you know what, we're going to push this as hard as we can to get this inflation thing under control, build ourselves some headroom, and it might even push us into a negative 1 or 2 quarters.
Snap the inflation stick and have the recession we had to have, which was when we had that incredible tightening of monetary policy in the early 90s. For people young who can't remember that period watching this today, that was an extraordinary period. That's one reason why we got inflation down, but it was driven by a recession. I think they've learned from that, Bill. I'm not sure whether they'd go that hard. They'd be willing to tolerate a period, whether that's a year or two with inflation above the target, if it meant avoiding a recession.
Yeah, I think the thing for them is that, I agree with you, Mark, what's the difference between 2 or 3, 3.5? It's what is important is stability.
Yeah.
So if the market, if the household sector believes that inflation is going to stay at 3, then that's no big deal. But if it goes from 2 to 3 and the household sector thinks, no, it's going to 4 next year and 5 next year, and behaves accordingly in terms of their wage claims, and businesses feel that they've got some flexibility and they feel they can accommodate that and raise their prices, then you're into this wage price spiral that we had in the 70s, which is very, very damaging. We had it in the 80s as well. So the rest of the world got out of it at the end of the 70s. We took another decade to get out of it, as Stephen says. Yeah. So that's what you've got to worry about. If you say, okay, we're still going to target inflation and it's going to be around 3 rather than 2 to 3, and people believe you, then I don't see that as being a major problem. But the problem you have is that people don't believe you because you're not tough enough to act in order to achieve those objectives. And that's the issue globally. The Fed wants people to believe that they're dedicated to containing inflation around that 2.5 to 3%, ECB the same. And so particularly when you're in a world where the unemployment rate is, we're at full employment, the cost of tightening to absolutely cement your commitments, I believe, is acceptable.
What about if we go and start doing what New Zealand's done, actually get pretty tough on it? And New Zealand's gone up again by 0.5%. But then I also saw that places in Auckland, houses in Auckland, are going down by more than 15%. New Zealand, across the board, is 15% reduction in prices. Auckland's greater because Auckland rose at a faster rate than everywhere else. I mean, does that represent to you, and you're at Westpac, does that represent to you, and say someone like me, is that a risk for us as lenders, because all of a sudden we start to see all the newer borrowers maybe have negative equity?
The key issue is what happens next year. So do you start to see the supply shocks flattening out? Do you start to see the weight on the demand parts, on the interest rate sensitive parts of the economy, starting to take the heat out of inflation? Because one thing we know for sure is that next year wages growth is going to be a lot stronger. So the objective that they've set themselves of bringing inflation down from 4 3/4 head underlying to 3 1/4 by the end of the year, that's a big objective. Particularly when you've got wages growth lifting. So you need 2 things to happen. I believe you need falling oil prices. So if we're in a situation where the oil price just continues to take off, we're in trouble. The other one that I think will happen is that the other major contributor to our inflation is building materials. And building materials, I'm very confident will start to flatten out. One, because one of the main reasons why the building material boom is happening is that they've used to import a lot of the stuff from the US. The US has now got a housing boom, and so there was a real restriction on the supply of new materials. Secondly, that sector suffered from the key inflation model, disruption on the supply side, big stimulus from the government handing out money, but they then had the second round where they had the home builder, which just put even more pressure on the demand for these materials, and that's the thing that's been driving the inflation. I think that will be pretty much zero next year, because that market, that industry is in real trouble.
Do they go backwards though? Like, there's a piece of timber.
Oh, sure.
Will it go backwards? Because
Well, the prices come down.
Yeah.
I would think, quite likely, particularly when the US, because the US housing market's rolling over itself at the moment, so there's more available material coming that way. So I think that component, which has been the biggest driver of inflation this year, will flatten out. What we don't know is some of these other parts of inflation, which is services and education and health and that, whether they take off because of this wages effect.
And that's a really important issue too, if I can butt in there, because Bill, you're spot on, but it's also the availability of skilled labour.
Yes.
Trying to find a plumber, electrician, a carpenter to build your house for you is incredibly difficult.
And if you get them, they're $100 an hour now.
Indeed, and so they're putting up their prices. So again, that whether it's the centralised wage increases on the minimum wage from Fair Work Commission and these sorts of things, which, from what we're hearing already from the new government, they're submitting for a high wage increase. They didn't put a number on it, but it's going to be a high number. But even just in the market forces driven wages side of the economy, the skill shortage and even unskilled shortage, like people picking strawberries, if you like, the backpackers, that probably will be alleviated because we're opening our borders. But when we've got an unemployment rate that's heading to 3.5%, possibly less, that there aren't that many workers out there. So if you're a business person, you say, oh, actually, I need to hire half a dozen more people. My business is going well. The economy's strong. Put an ad in to sort of hire some people. Either you can't find them, or the people who do apply say, hang on, I'll do the job, but you've got to pay me much more than you're anticipating as the person putting that in. So that wage pressure permeates through the whole economy. And that's why I also think that the task of bringing that inflation rate back down, even when we do get the supply side being fixed with timber and steel and these sort of things, we've got a wages issue, I won't call it a problem yet, but a wages issue that will probably linger into 2023.